The onset of the COVID-19 pandemic in 2020 sent shockwaves through the global economy. Lockdowns and business closures triggered a sharp decline in economic activity. Unemployment soared as businesses struggled to cope. Central banks around the world responded with unprecedented monetary easing measures. Interest rates were slashed to near zero. Quantitative easing programs were launched on an unprecedented scale. Central banks injected trillions of dollars into the financial system by purchasing government bonds and other assets. The goal was to increase liquidity, lower borrowing costs, and stimulate spending. These actions were taken to prevent a complete economic collapse. Governments also stepped in with massive fiscal stimulus packages. These packages included direct payments to individuals, expanded unemployment benefits, and loans and grants for businesses. The combined force of monetary and fiscal stimulus provided a lifeline for many individuals and businesses. They helped to cushion the blow of the pandemic's economic impact. However, these unprecedented measures would have far-reaching consequences in the years to come. As economies began to recover from the initial shock of the pandemic, a new challenge emerged: inflation. The massive injection of liquidity into the financial system, coupled with supply chain disruptions and pent-up demand, led to a surge in prices. Inflation rates soared to multi-decade highs in many countries. Central banks, initially slow to react, soon realized the need to shift gears. Aggressive monetary tightening cycles were initiated to combat rising inflation. Interest rates were raised rapidly, marking a sharp reversal from the near-zero rates of the pandemic's early days. Quantitative easing programs were scaled back, and central banks began to reduce their balance sheets. This shift towards tighter monetary policy aimed to curb demand and bring inflation under control. The transition from aggressive easing to rapid tightening created volatility in financial markets. It also raised concerns about the potential impact on economic growth. The effectiveness of these measures in taming inflation without triggering a recession became a subject of intense debate. Central banks faced the difficult task of finding the right balance between controlling inflation and supporting economic recovery. The COVID-19 pandemic and the subsequent policy responses had profound effects on labor markets and asset prices. The pandemic accelerated existing trends in the labor market, such as automation and remote work. Lockdowns forced businesses to adopt remote work arrangements, leading to a surge in demand for digital skills and technology. This shift towards remote work had mixed impacts on workers. While some benefited from increased flexibility and work-life balance, others faced isolation and challenges in separating work from personal life. The pandemic also exacerbated existing inequalities in the labor market, disproportionately impacting low-wage workers and those in sectors heavily reliant on in-person interaction. The aggressive monetary easing measures, while intended to support the economy, also contributed to a surge in asset prices. Low interest rates and ample liquidity made it cheaper to borrow, fueling demand for assets such as stocks, bonds, and real estate. This asset price inflation raised concerns about potential bubbles and exacerbated wealth inequality, as those who already held assets benefited disproportionately. The long-term implications of the COVID-era monetary policies are still unfolding and remain a subject of ongoing debate. One key concern is the potential for these policies to have fueled inflationary pressures that could persist even as the pandemic recedes. The massive increase in government debt taken on to finance fiscal stimulus packages also raises concerns about long-term fiscal sustainability. Central banks face the challenge of unwinding their unprecedented interventions without triggering market turmoil or stifling economic growth. The timing and pace of this unwinding are crucial and subject to intense scrutiny. Another debate centers around the effectiveness of traditional monetary policy tools in addressing future economic challenges. Some argue that the pandemic has fundamentally changed the economic landscape, requiring new approaches to monetary policy. The role of fiscal policy in supporting the economy, particularly in times of crisis, is also being reassessed. The COVID-19 pandemic has forced a re-evaluation of long-held assumptions about economic policy and highlighted the need for greater coordination between monetary and fiscal authorities. The lessons learned from this period will continue to shape economic policy making for years to come.